Thanks everyone for joining again. A bit of administrative work. I'll just send links as a reminders. We are going to start an income statement today. The income statement is a bit different from the balance sheet in a few aspects. First of all, income statement is more or less it's kind of more intuitive than the balance sheet. It kind of feels easier based on the common sense to understand what your income is and what your expense is. And that is why we will do that. We will do income statement in a practical manner. You can try to follow me on that. And if you lose the speed, you can catch up later after the lectures, or you can just look what I am doing, and you can just do that after the lecture. So either way is possible. I will be try to move as slow as possible. Here on that link, I will share it to the chat. On that link, you will have AMC financials. And what I want to do, no, let's do something else. I don't like AMC, too complicated. Let's go with Apple filings. And okay, let's do quarterly filings, the most recent quarter, HTML. Okay, so I copied Apple financials, and I also created a new sheet. I created a new sheet in the homework file. Okay, it doesn't allow me to copy. What else? Okay, let's try to get that in Excel. That's interesting. Okay, so you'll probably have to get an Apple file from my files. I'm trying to figure out the way to copy Apple income statement to the... they did it in a so awful format. Okay, what is RTF? I'm currently opening Apple financials. I want to copy an income statement to our working files so that we will work on building our own income statement, and at the same time we will have Apple income statement to look at. Yeah, formatting is also not great, but hopefully it will work out somehow. If not, I will improve the formatting on the next module. Okay, I was able to do that. That's in my file. I will call it income statement and I will go back to Apple website and open PDF. So here I have a link to PDF, and also I will share a link to my homework file. And that's the link to the file where I do homework, where I have that file. Let's go back to the Apple statement. That's not Apple. Okay, that's an Apple. As you can see, the structure of the income statements can be quite different between the company. For example, Apple's income statement of Apple is quite condensed. So they say, okay, here are our product revenues, here are our services revenues, here are our cost of sales for products, cost of sales for services, then they have research and development, then they have sales, general and administrative expenses, they calculate their operating income, other income and expenses, and they have income taxes. So that's pretty much it, pretty consolidated for Apple. Please note that these amounts are already aggregated. So in the Apple chart of accounts or in Apple trial balance, you will have hundreds or maybe even thousands of different accounts for many types of expenses and incomes, and you will also have many different companies which are consolidated into Apple. If we take a look at AMC here, we will see that they have like three revenue streams: admissions, food and beverage, other, and other. They also got like quite detailed cost breakdown here. Film acquisition costs, food and beverage, operating expense excluding depreciation, amortization. They have rents, they have G&A, same as Apple. They have depreciation and amortization separately. They have other expenses. They have interest expense. Apple should also have interest expense somewhere on their books. That's strange that Apple didn't separate interest expense. I would expect interest expense to be somewhere there. Probably their interest expense is not very significant to reflect separately. So income statements can look quite differently, and that's a bit opposed to the balance sheets, because on the balance sheets you have usually very similar accounts that do not change much when you move from one big company from another. That's the substance of the income statement, because income statement is more dependent on the type of the business you are in. So we got that copy here. Let's go do a bit of a theory. Let's go back to the MIT lectures. We will go through lecture 3, and we will practice income statement preparation while we are going through the lecture 3. Okay, what did we have here in the beginning? I'm just checking that we are not missing anything. That's the answer for the previous lecture. We will not stay long here. It is just a discussion what operation result in an assets and what in a liability. Accounting transactions. What business transactions are recorded in the financial accounting systems? If you remember, we discussed accounting transactions in the module 0. So what we can do a quick repetition about that. So if exchange of assets and liabilities happens with other entities, then we recognize the transaction. I don't know what does executory mean. Okay, supplier, customer, exchange of promises. Okay, so if you just do an exchange of promises, you do not recognize the transaction. The transaction needs to actually happen based on the signed contract. Again, they go through some accounting equation stuff. That's kind of repetition of the previous lecture. You can do that, or you can skip it. If you have good understanding, you can skip it. Okay, and here we go to income statement. What do they have a transaction for income statement here? Okay, they probably repeat the previous lecture material. And now in the income statement, they have revenues, and they say, okay, that's fees for the service. And they have expenses, wages, interest, maintenance. And most of the time, revenues are just revenues from selling the products, like in the Apple case. It's revenues for the products or revenues for the services. In AMC case, AMC is a company which is selling kind of services mostly, and they sell food and beverage probably as an extra service. So they break down it into more details. They say, okay, we have admissions, we have food and beverage, and we have something other, I don't know, subleases, events, or some exhibition revenues, whatever revenue streams they can find. Let's go back to MIT. So usually you have just several items in your revenues. You just do several different things, and that's all. And for expenses, you can have hundreds of different accounts in the expenses. And the reasonable question is, how do you figure out how much expense accounts do you need? And the rule of thumb is that you create a separate expense account for each type of expense by substance. So, for example, if you pay for advertising, you need to create a separate advertising account. If you rent a property, you have a separate account for property rentals. If you pay for maintenance, you have a separate account for maintenance. Let's go back a bit to advertising. If you advertise on TV, advertise on social media, advertise, for example, on Facebook, advertise on Google. If all of those are significant numbers for you, if you feel it will be better to know all those numbers separately, you can create 3 different advertising accounts for TV, for Google, for Facebook. Your managerial discretion, your managerial decision should drive the level of details you need for your accounting. That's only one of the drivers. So if there is a business need to monitor those accounts separately, you better keep them separately. The second input is, if some kind of expense receives a special treatment from the IRS, you need to keep that expense separate in your accounts. And not if I was not clear at that point. So on the income statement, we will have aggregated amounts. Like Apple here, cost of products, cost of services, goodbye. Your tax return and your managerial data will not be built on income statement account. It will be built on a trial balance account, and your trial balance is based on the chart of accounts. So trial balance is basically your chart of accounts, but with numbers, with actual monetary amounts. And when I'm saying that you need to keep your expenses as granular as possible, I say that you need to keep your trial balance as granular as possible. So one of the reasons for that is you need to do that when you have a business need. The second reason for that is you need to do that because IRS requires you to do so, or because you need to have that amount separately to be able to reconcile your accounting with your tax books. Let me give you an example. In accounting, you depreciate fixed assets, and you usually do that ratably on a straight line basis over a period of time. While in IRS, you have several different options. You can get a bonus depreciation. For example, IRS may allow you to write off the full amount of fixed assets purchased in the first year. And that's great for tax optimization. You kind of save your taxes and you kick your taxes back into the future. So you saved on taxes, you depreciated 100% of the asset cost in tax books, but you still, in accounting, you still have to depreciate it ratably on a straight line basis over life of that asset. And you got a difference. And to be able to reconcile that difference, you need to keep depreciation expense separately from your other expenses. You should not keep all your expenses in one bulk account with everything possible. Otherwise, you will not be able to complete your tax return for your business. Same for example, same situation with a use of a personal vehicle for the business. If you remember, if you use a personal vehicle for your business, if you are a small business and you use a personal vehicle for your business, you can allocate part of expenses from usage of your personal vehicle to your business expense and reduce your taxes. And you can do that either by allocating some portion of actual expenses, or you can use a mileage deduction. That's why if you use your personal vehicle expense in your business, you need to track those expenses separately on a separate account. Next example. If you use home office for your business, you can do that for IRS purposes. You can do that on a two different bases. You can try to calculate the actual expense of having home office, and you can probably allocate some part of your house expenses to that home office based on square footage or other objective measures. Or you can take a standard deduction for home office. So if you have your home office mixed up with other expenses in your business books, it will be very hard to you to fill in the income tax return for your business, because it will take time to figure out what's related to your home office. And there is several other categories in your income and expense accounts which can get a separate IRS treatment compared to the other option. For example, charity. Your charity, if you are sole proprietor, your charity will not be an expense for your sole proprietor business or for your flow-through LLC. Your charity will be deducted on your personal return. Even if you did charity contributions through your business, which is a flow-through entity, that item will flow through to your personal return, and it will only be deductible if you itemize on your personal return. There is many situations when you can have issues with that. So the general rule is be as much detailed in your accounts as possible, as needed for the business, and also takes into the account when IRS requires you to be detailed. Sorry? Yeah, I'm starting to lose my voice. Too much talking today. Let's see what we have further in the MIT lection. So we discussed what expenses are and how to figure out the expenses. We will also practice some income statement transactions on the next lesson. It's not the first lesson for the income statement. We will practice too on the next lesson. Okay, they have okay, lecture 3. It was I was expecting to see only income statement here. Okay, finally, income statement. Cash investment in a one period world. Cash invested, cash returned. Shipping expeditions in the 15th century. So, somewhere at the beginning of the business, there were businesses with just one cycle when they did like a merchant expedition or shipping expedition to somewhere. They bought goods there, they returned, they sold the goods, they sold the ship, and that was all their operation. And they calculated the profits, and the expedition was dissolved. In that situation, you didn't need much accounting. So you started with the cash, you invested cash in a ship and goods, you turned everything over, and you sold the ship and goods at the end, and it was just one cycle, and you ended up with a cash, and you dissolved whatever you have, whatever partnership you have for that purpose. In that situation, you didn't need to account everything. But in a current business environment, you operate like many business cycles at the same time, and there is no predetermined end to the firm's life, which is in accounting that's called going concern concept. So it means that your business has an assumption that it will continue its operation in the foreseeable future. And cash is invested and generated in many cycles. Also, compared to the early times, we got some taxes and regulators which will tell you that you actually are required by law to keep your books, and you're required by law to keep your revenues and expenses organized and recorded, and you need to keep the supporting documentation to be able to file with the SEC timely and file with the IRS timely. And you also actually need all this data for the management purposes too. So that's kind of sending us back to the discussion about managerial accounting, financial accounting, and tax accounting. So yeah, you are in current situation, you are required to keep your records. And there are some accounting principles like objectivity and conservatism that one says that all your accounting transactions should be verifiable and reliable. Basically, you need to keep the records to support your transactions, and those records should be of good quality. And conservatism, that you should be more conservative about your gains. So if you record a gain, it is generally supposed to be more verifiable and more reliable compared to when you do an expense. I do not think that it's currently required by GAAP. Let me add that to the question list to further investigation. Where is my question list? I have a memory that conservatism principle is kind of no longer applicable, and you just need to be objective about your incomes and expenses. But let's move on. So revenues, sales or service revenue, gains, selling an equipment for cash greater than the net book value, expenses, cost of goods sold, operating expenses, losses, other revenues and expenses, interest revenue, dividend. So basically we have a list of various revenues and expense accounts here. The income statement measures firm performance regardless on when cash is exchanged. Towards this end, two key principles are revenue recognition, earnings process substantially complete, cash collection reasonably assured. So when you do firm's income statement, you usually disregard when are you going to receive the cash. If it's a less than 12 months period, you usually disregard that. So you might have like a huge revenues, but your cash account in the bank might be empty just because you haven't collected that revenues from your suppliers yet. And we also have a matching principles here, that we need to match the efforts to the benefits generated. So the efforts, when they say the efforts, it means the expenses. And when we say the revenues, we say the revenues generated. So to generate the revenues, we need to incur some expenses like labor, use some inventory, use some fixed assets, and all of that combined as a business will generate your revenues. For example, if you bought a merchandise, but we haven't sold it yet, we do not recognize it as an expense because it's in our warehouse and it sits in our books. But when we sold the merchandise, for example, if we sold half the merchandise, we will record the revenue, and for the cost of sales, we only record the cost of the half of the merchandise sold, not the full inventory balance with merchandise. So we also capitalize expenditures that will benefit future periods, expenses and expense them when the benefits are realized. If you remember our homework transaction with a tracking expense related to equipment bought. So we paid for tracking for the piece of equipment to be brought to our premises, and we said that based on accounting principles, we capitalize that cost on the cost of equipment. And that cost of equipment as a total the cost of the piece of equipment itself, cost of the truck into the location, cost of the installation, it's all capitalized as a cost of your property, plant and equipment, and then it is expensed over the period of time in accounting. It is expensed most of the time on a straight line basis over the expected useful life of that asset. So great. That's also the matching principle. Recognize liabilities when efforts benefiting the current period require cash payment in the future. That's a bit complicated. So basically, we recognize liabilities when we get an obligation to pay the cash in the future. But it might not be cash. It might not be. We might be able to settle that liability with future revenue, or with the delivery of a future. With a delivery of asset in the future, asset different than cash, produces a difference between cash flow and earnings. Yeah, the matching principle is the one which produces a difference between your cash flow, inflow and outflow, and your expense and revenues. For example, if you buy an asset, a truck, and you use it over 10 years, your expense for that truck will be 1/10 of that truck's value over each of the next 10 years. But your cash flow, let's assume you paid with the cash for that truck, your cash flow will be a huge outflow on the first year, but then you will have zeros for every next year up until you retire that truck. So that's why we have difference in the matching principles. That's fun. They have an example about Blockbuster video here. Blockbuster was a big video rental network, probably 10,000 locations right before Netflix. And currently I think there is only one shop left, just as a museum. But okay. Blockbuster Video buys a copy of the Matrix Reloaded video for $20. Experience indicates that video will be rented 50 times in year 1 and 17 times in year 2. How much should Blockbuster recognize as an expense each year? So let's can you put your guess in the chat for that? You do not need to calculate. You can just tell me the principle. How do you think we can allocate? That $20 around these periods? Should we do it ratably, like evenly between the 2 years, or shall we allocate more to the first year and less to the second? I'm giving 1 minute for that. Okay. Basically what they say us here is that, yeah, we need to take into account the actual pattern of consumption of that benefit. And in that case, it will be like 67 rentals over 2 years, and then we allocate like approximately $15 to the first year and $5 to the second, and we recognize the expense based on that principle. They also give us the different expectations. Like if we expect that the expense will be allocated that way, we allocated it by 10-5-5 basis. And here they give us like a it's a bit a simplified form of the accounting equation, and it shows the cash movement and video asset movement and retained earnings effect, income statement effect. So we bought video asset for $20. That transaction doesn't have an impact on the income statement. It's just a balance sheet movement, as we did in the accounting equation. Credit cash, debit video asset. Then we got some revenue for renting out that asset. We got cash, debit cash, and we recorded a credit to retained earnings. In our spreadsheet, that should be negative. It's a credit revenue, credit retained earnings. Our retained earnings or revenue increased due to that transaction. So we would have like a negative number here. Okay, end of year 1. And we record the expense from our previous calculation here. $15. Let's see. Yeah, we record $15. Credit video assets or credit accumulated amortization of video assets, and debit retained earnings. So basically, yeah, the principle here, they use they don't use the principle that credits are negative. They use a different principle. So we need to pay some attention to here. So we credit video asset and we debited retained. We decrease the retained earnings by the amount of the amortization of that video assets. So we also record the second year income and expense. $51 earned and $5 expensed. Total expense $15. We fully amortized that video assets and we reflected revenues and expenses in the retained earnings. Let's now switch to practice. And let me open the homework file here. And I will do that. Okay, let me move transaction list here. I will continue to do that in my file. And then we will reflect that in the income statement. Let me do some template work here. So I have revenues. Let's say I want to have a okay, let's follow the Apple template. Net sales, revenue, product, revenue, services. Where do we get that these items from? Where do we get these items from? Do we get them from the transaction list or do we get them from some other source? And the answer is we get them from trial balance. Let's see what we have in our trial balance. We have just revenue and we got cost of sales. Okay, that's pretty aggregated. Let's move here and say that we now want in our trial balance we want to have revenues by products and revenues by services. But when we change that, our sum if stops working. So we need to take revenue by product account and push it down into our transaction list. Let's see where we have revenues here. So this one, we sold inventory. That's revenue. And the next one, generated from sale of services. So that one will be services. Now, and we need to kind of copy it here. Cost of sales. Okay. Let's go check. In our current business, all cost of sales which we recorded was due to usage of the inventory. It was due to usage of inventory. So we can change that from just cost of sales to what? Cost of products sold. Cost of merchandise. We had merchandise. But as a business owner, so your business, your theoretical business here, it is selling products as well as doing some services. And what if you use the same inventory in your product business and you use the same inventory in your services business? Do you want to disaggregate the amount of inventories, the amount of inventory you use in your products and in your services? Of course you want to do that. That's because you need to know profitability of each line of your business. What is if you charge for your services less than you use inventory in rendering those services? What if you sell your products at a loss because you do not record the amounts separately? So basically we will call that cost of merchandise used for services. Okay, again, we need to update our amounts. So first, cost of merchandise sold. Yeah, that's here. And second, cost of merchandise used for services. Okay, let's move here. Revenue services. Okay, cost of merchandise used for services. And that way, we update it. Let's add one column here. So here we have a mapping to the balance sheet where we sum if the balance sheet amounts. If you can see, for some reason our check went out of balance, but that's because we increased the amount of lines in that file and one line dropped out of the file. So I will just do like a 26. Yeah, it's now 0. So our trial balance check is still working, and we updated. We updated here, and here we will do income statement mapping. So far we don't have a lot of income statement accounts, but when we develop our income statement further, we will add more accounts. Let's see what we have here. So we have revenue, products, and services. We will follow an Apple example. And what Apple has got here. Products, okay. Let's just say cost of products, cost of services. We want to be a good managers of the company, and we want to provide a good value to the business owners. That is why we want to separate different kind of products into our accounting. Sometimes it's straightforward, sometimes it is not straightforward at all. And here we are just running the basic example. So let's see. Okay, now we need to use a SUMIF function. Hopefully you already learned that function by today. So first we need to select the range where we will seek for the criteria, and that range will be in the trial balance in the first column. Then we need to select what criteria to look for. In that case, that will be revenue products. And then we need to select the sum range, which we select from the totals here. And we close it. Okay. And we also copy that. We also copy that to here. Is it? Can you write something in the chat about? Is it? Does it have common sense? Is it common sense applicable to what I'm describing here, or is it a bit complex to comprehend? Gross margin. So next step, I calculate gross margin. So it's kind of a subtotal. It is negative. In the public financials, you will usually see that there is not much negative signs here, or you'll probably see the expenses with a negative sign. I will keep it like the credit balance. The credit accounts will have a credit balance, and the debit accounts will have a debit balance. When I say the credit account is the one which increases by credit, and the debit account the one which increases by debit. I kind of realized that I need to reschedule the next module. I will do that in a second. Oops. Sorry, I'm not able to reschedule the next stream because it interrupts the current stream. Sorry for that issue. I didn't know that. I cannot do that. Let's see. What else can we do? So in operating expenses, we have research and development, and we have selling, general, and administrative expenses. Let's come up with some selling, general, or administrative expense. Let it be advertising expense. Okay, I need to format that. Okay, let's go to transaction list, and I will leave that homework so far around. Let's say we incurred advertising expense 5k paid with cash. What will be debit, what will be credit? You have a minute to think what will be the debit, what will be the credit. I will go back and I will update a trial balance with that expense. Let's say it was social media. Let's be more granular. In transaction list, advertising in okay, that should also go to expenses, and that in most circumstances should be general, selling, and administrative. Okay. Yeah. So basically we will debit that account and credit cash, and we will do that for 5,000. Let's see. Let's update that formula. And let's also come up with, okay, they have total. Yeah, Apple has total for everything. I will skip totals just to be less, save some lines here. So let's come up with operating income. So our operating income will be gross margin plus whatever we have for the operating expenses. And that is still a profit of $1,000. So that's interesting. We become much less profitable due to advertising. Okay. Is the principle? Are you getting a grasp of the principles of income statement? So what we can do? We can do that. We can add some hint here. Income statement, or I'm just checking if I'm not getting any messages. Okay, no, that's not course related. Or balance sheet. Transaction. I'm making some cheating here, so I will just notice what accounts have an impact on the income statement. Okay, revenue has an impact. Revenue. Okay, so these are the only transactions which have impact on our income statement currently. Please note I have an incompleted piece of homework here in my file. I will complete it later, and it will be included in the operations. But so far we are working with the income statement, and we created a small income statement which takes numbers from trial balance. So these are income statement accounts, income statement level of detalization. This is balance sheet mapping, balance sheet detalization, and this is trial balance detalization, which is the most detailed and we should have all our accounts here. Whatever we used in transaction list, we should see here. Otherwise, your check might not be equal to 0. That's why that's a good practice to make a trial balance. After you enter additional transaction, you check your balance. You check your trial balance. Okay. Let's see if we have anything left in the MIT module. Okay, we recorded all these expenses. 10,000 worth of cereals from special foods for cash. What is cost of goods sold? Qmart. I don't think Qmart exists anymore. But if you just buy inventories for cash, you will record inventory acquisition. You will not record expense. Exchange one asset for another asset. It's not an expense. Operating outflow 10,000. If it is a merely cash outflow, it will not generate an expense. Qmart sold 1/2 of the cereals for 8,000 cash. Now this is something we speak about earlier. We sold half of the cereals for 8,000 cash. Let's see, and here we bought 10,000 cereals. So we sold half. Our expense will be half of that. Let's see. Let's reflect that. Let me check time for a minute. Okay, we are running of time. We are running of time for that lecture. Let me see if what else do we get in the lectures for today. So we have gross profit, components of income, staples, just an examples, advantages of income statement, components. Okay, we will leave that for Q&A sessions and for other lectures. We will get back to that. For that lecture today, for the income statement, we will stop on creating that simple income statement, and in 10 minutes we will have a lecture on practice session, and on that lecture I will continue doing some to do some transactions for the income statement, and I will also give you more detail about homework, but I will email the homework later. With more details about what needs to be done. So thank you so much for joining. Let's meet on the other section. We have 10-minute break. I will let everyone in the chats know. Have a great day. See you in the next lecture.